Hello, I'm Jasper.
Hello, I'm Ben Cunningham, and today we are going to be presenting our Managing Finance assignment.
Today, we'll be sharing our investment recommendations with you. Firstly, looking at your client overview, we understand that you've recently inherited £100,000 and are looking to grow your wealth. Your investment priorities include liquidity, growth, risk, and return. Liquidity refers to how easily an asset can be converted into cash. Growth is the increase in an investment's value over time. Risk is the level of uncertainty you're willing to take, where a higher risk can lead to a higher potential return. And then finally, return is the profit generated from an investment over a given period.
Now we have a quick slide outlining the two main types of investments, physical and financial. Physical investments involve tangible assets like property, art, and cars, where profits are generated through their management or resale. Financial investments involve capital being used to hold a position in stocks, bonds, and funds, with profits earned from market growth or dividends.
Our first recommended investment is putting £20,000 into an index fund. An index fund is a collection of companies that represent the overall market, offering diversification and reducing risk. One option we suggest is the Vanguard S&P 500, which tracks the top 500 US companies. Investing in an index fund allows for steady growth with low maintenance and costs. This allows you to spread risk instead of placing all your eggs in one basket. We prefer an accumulating S&P 500 index fund when compared to a dividend one. This allows you to achieve compound interest, where your profits are reimbursed into shares. When held in the stocks and shares ISA, any returns are tax-free and benefit from compound interest. Looking at potential returns, the Vanguard S&P 500 Index Fund currently offers an annual return of around 9%, which would generate approximately £1,800 in the first year. Over 10 years, with reinvested returns, your investment could grow to around £47,300. To summarise index funds, they are highly liquid, tax-free and low-risk investments that maximise your return.
Next, we recommend investing 20,000 into a UK government gilt, specifically the TR 491 7/8% index-linked Treasury gilt, maturing in 2049. Gilts provide annual payments and are government-backed, making them a secure investment option. As this gilt is index-linked, its value will rise with inflation, ensuring your purchasing power is maintained. Additionally, while the annual interest is subject to income tax, the final payout at maturity is exempt from capital gains tax. Based on our calculations, this investment could yield approximately £2,500 per year, though this depends on your tax bracket. To sum up, gilts, they are low risk due to being government backed, which does mean they are low liquidity, as you must wait until the bond matures to sell them.
For your next investment, we suggest allocating £20,000 to Lloyds Banking Group shares. Owning shares gives you part ownership in a company, along with potential for dividend payments. Lloyds offers a stable, low-risk investment with a dividend yield of around 4.4%, meaning you'd earn approximately £888 per year. Shares in Lloyds are also highly liquid, allowing you to sell them easily if their value increases. While the share price is not expected to grow rapidly, it provides a consistent and reliable returns. This can be seen in this slide here.
Next, we have decided to recommend you invest £10,000 into a gold exchange traded fund such as gold SPDR. Unlike buying physical bullion, investing in a gold ETF allows you to invest in a fund which tracks the price of gold. This allows you to handle a fund which mimics the price movements of gold. This is a lot more liquid than physical gold due to the ability to quickly sell it on the stock market, and offers reassurance due to the security implications of storing real gold. Gold is often referred to as the money of the gods due to it being a finite resource, hence this fund will help you hedge against inflation. The risks with this stock are very minimal. However, with the constant fluctuating economy, there may be some movements in share price. On the contrary, this may be seen as a positive, as many investors use gold as a safe haven asset. So if the global economy is bearish, then many investors will hedge their capital into gold, which in some cases will push the share price upwards. Gold SPDR has seen a 10-year average return of 9.7%, which reinforces the importance of holding gold investments in your portfolio. However, with gold ETFs, a yearly management fee of 0.4% will be owed. This is due to these ETFs storing physical gold as their primary asset and having to manage them. Here we have a graph which shows the historical value of the gold market, which has always survived every economic downturn. We have also created a table to show the estimated returns from your £10,000 investment. This should work out at around £930.
We also recommend investing £20,000 into real estate investment trusts, specifically the British Land, which is part of the FTSE 100. A real estate investment trust allows you to invest in large-scale estates without managing properties directly. Hence, real estate investment trusts are highly liquid compared to their physical counterparts. Instead of waiting for property to sell, you can sell them quickly on the stock exchange. One major advantage of real estate investment trusts is that they must distribute 90% of their taxable income as dividends, making them an attractive source of passive income for the investor. British Land has a dividend yield of around 6.31%, meaning you could earn around £1,262 annually. While the UK property market has grown significantly, the main risk of real estate investment trusts is that property values and dividends can be affected by the economic downturns, which can be seen on the graph to the left.
For a high-risk, high-reward option, we suggest investing £5,000 into Thales, a defence contractor stock. Thales recently signed a £1.6 billion deal to supply air defence missiles to Ukraine, and with ongoing geopolitical tensions, we could see further military contracts driving the stock price up. However, if global conflicts ease, demand may decrease, impacting share value. Thales also offers dividend payments twice a year with a yield of 1.39%. This means you would earn 1.39% of your investment annually, subject to dividends tax. Looking at the historical performance of Thales, the stock has grown significantly, and if trends continue, it could provide strong returns over the next decade. On this slide, we have found a graph showing the full history of the Thales stock. In the graph, you can see how it reacts to geopolitical movements in recent history. An example is when Trump came into office at the start of 2025, and the price of the share skyrocketed by over 80%.
We also advise keeping £5,000 in an instant access savings account. This ensures you have emergency funds available while still earning passive interest. Having accessible savings provides financial flexibility in case of unexpected expenses or future investment opportunities. Different banks offer different interest rates, but the higher the rate, the greater your return. Savings are extremely liquid, as it is just accessible cash on demand. The following slide just shows your potential returns, what they could be from a different interest rate.
On this slide, we have forecasted your potential returns. However, this discredits taxation, which we will explore in more detail in just a moment.
Now, we want to briefly touch on the market efficiency hypothesis, which explains how information affects stock prices. There are three levels of market efficiency: weak, semi-strong, and strong. Weak form means past price trends cannot predict future prices. Semi-strong form suggests that all publicly available information is already reflected in prices. Strong form assumes that even insider information is accounted for, making it impossible to gain an advantage. The investments we have recommended, index funds, gilts, shares, real estate investment trusts, and event stocks, fall under semi-strong market, where prices reflect known information.
When investing, tax is an important factor to consider. You're subject to tax on some of the returns you will make. Firstly, this all depends on which tax bracket you're currently operating in due to your yearly income. In this slide, we have shown the brackets that the government have installed and how much tax you would have to pay. To showcase the implications on tax, we have estimated that your income should be around £30,000 per annum. This would mean you would fall within the basic rate tax bracket. This means you would be subject to an 18% capital gains tax on profits exceeding the £3,000 annual allowance. And for dividends, the first £500 is tax-free, and anything above that is taxed at 8.75%. These rates, however, may change if your income decreases or increases.
Finally, to end, we have a table which shows us and estimates of what your £100,000 investment may look like at the end of the year. Starting from left to right, we have your tax bracket, which we believe to be the basic rate. Next, we have the investments, which we recommended to you. Thereafter, we have the investment type. Following this, we have the allowance which these investments will receive, and then we have the percent of tax in which you face on these investments. Then we have the estimated returns pre-tax, which comes to around £7,861. We then have added what the tax payment on the returns is, ending with the overall returns made post-tax, which accumulates to around £7,456 for the first year. However, due to compounding and stock growth, this return should likely grow year on year. We have not added the savings accounts due to this, due to every bank offering different interest rates.
We hope our recommendations help you maximize your returns and make informed investment decisions. Thank you for listening.